We had a crazy rally on Friday after Jerome Powell has signaled potential rate cuts, and he has even signaled the Fed potentially abandoning the 2% inflation target. It has shocked the markets. Bitcoin went up, Ethereum went up, gold went up. Anything that's pretty much a dollar hedge or against the dollar has done extremely, extremely well on Friday. But the question is, where do we go from here? Many investors are saying that this is some kind of a bear trap where we went down over the last few days, then we went back up. People believe that we're going to crash, we're going much, much lower, but it's not actually going to be a decline. And this is just some kind of a bear trap before we reach the euphoria phase and we skyrocket a few 100%. This is the first case scenario. The second case scenario that could happen is this is some kind of a bull trap where we actually did recover from the decline and people believe this is over, but it's not over and we're going much, much lower. And it's very hard to make the case for this rally to continue because it would be the third year of 10% plus returns. And that doesn't happen very often. Anytime we have 3+ years of positive 10% return, year number 4 normally it doesn't end too well. It tends to be a very ugly year for stocks, and it just doesn't happen very often. But in this video, I'm gonna talk about the 400% rally title that I talked about in this video. I'm gonna explain to you why it could potentially happen, maybe not 400%, but something close to that. And I'm gonna give you my opinion on the market and everything in general. So I really hope you enjoy it as always. And I'm also gonna give you a list of stocks that could do extremely well if the market or if interest rates continue to decline, as Jerome Powell has highlighted, they could do really, really well. And some of them are trading at 52-week low. Now, the title of the video is mainly based around a recent interview by Bloomberg from Howard Marks. And Howard Marks is a legendary investor, and he's very well known for predicting market cycle. He even wrote a book. It's called Mastering the Market Cycle. So he really understands investors' psychology and market cycles. And Howard Marks, he warned of early US stock bubble signs due to the AI hype. He said we're very, very early. We're not late, we're early. And there's 3 main points that I have to talk about here in the video. The first one, he said there hasn't been a serious market correction in about 16 years. And all the sell-offs we had, like COVID and 2022, they don't even compare to the great financial crisis when the market plunged by more than 50% and it took years to fully recover. So in other words, investors got complacent. Investors have in their mind that I just buy the dip and my stocks will recover by the end of the week, or they're going to recover within 2 to 3 months. And even now I see on the internet where investors are upset if their stock hasn't moved in 2 or 3 months. So very few investors have the patience to wait years and years like they had before. And we haven't had a serious market correction. Every dip was bought, and investors have this in their minds where, oh, if we have a correction, I just buy the dip and then I'm green by the end of the week, or I'm green in the next few months. What if it took 7 years to be green? Would you still have the mentality to buy the dip? Or what if you experienced it recently? Would you still be so confident to buy the dip? So what Howard Marks is saying is that it's very hard to overshake the buy the dip confidence. And we have the massive buy the dip confidence in the market. It's been easy. It's been too easy. And that participates for much higher prices because investors are just there to step in and buy the dip. And it's very, very hard to break this mentality. So this is one reason why he believes we're still very early in what he would call the AI kind of bubble. There's another reason why he believes we're still early, and he said valuations are high, which is true. And he said that he's not concerned about the Magnificent Seven stocks because earnings amongst of those firms are still strong, which could mean they're fairly valued. The problem lies in the other 493 stocks in the S&P 500, which he has also highly valued despite not producing the same results. So the truth is most of the growth in earnings are coming from the big 7. The big 7 are a little bit expensive. Yes, maybe not all of them. Amazon is not too expensive. Google is not too expensive, but they're producing the earnings growth. The other companies, Clorox and other companies, or Procter & Gamble, they're not producing the earnings growth, but they're trading above 20, 22, even 25 times earnings, some of them. So the bubble, what he's saying in terms of valuation, isn't really in the big 7, but it's in the 493 stocks, which I found very, very interesting. Now, the last part of this interview, which is the most important one, he said investors are extremely bullish. The last time the investing environment has looked this optimistic was around 1997. Now, you remember 1997, you remember 1999, you remember the dot-com bubble, and you're asking yourself, what do you mean we're in 1997 and stocks go up? Well, from 1997 to the peak of 1999 top, we went up 415% on the NASDAQ. 415%. And that was pretty much the same environment. We had high valuation, we had a little bit of an easing Fed, and we had concerns of, again, high valuation, exuberance, and all those things. But there was so much optimism in the market, and the optimism feeds on itself. Prices go higher, investors believe they missed the bottom, so they buy more of those stocks, and they buy the dip, and they keep buying, and stocks go higher, and they buy the dip, and it just feeds on itself until it gets to levels that you just cannot justify the fundamentals. And what Howard Marks is saying is that we have euphoria in the market, but we're not at a peak euphoria level where we're like in bubble territory, and there's no way you can justify the fundamentals. You can still justify the fundamentals of NVIDIA, of the Big Seven, but we're not at a stage where you just, no matter what you do, you just absolutely cannot justify the fundamentals. And this is what he said. He said, people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. That's just what I said. And that's the continuation that creates bubbles. And we're probably in the early days of that, not in the late days. We're probably in the early days of that. And I think that's mainly what Howard Marks is saying. He's saying that we're mainly in optimism. This is a cycle of markets emotion for investors, and we're mainly in optimism. We're not in euphoria yet. We're nowhere close to some kind of a peak bubble, peak valuations, peak everything. We're mainly in the optimism phase. And from the optimism to peak euphoria, you can have one of the best rallies you have ever seen in your lifetime. And you really don't want to miss those. That's just what I'm saying. But there's a lot of things that could back up what Howard Marks is saying. And I want to be clear. He's not saying that we're going to rally 400%. He's even saying that maybe it's time to be a little bit cautious, but not to like go all in cash or be like sound the alarm. He's saying we're still in the early days, but it makes sense to be a little bit more cautious. But there's a few things that back it up. One of them is historical signals of what has happened whenever the Fed has waited 5 to 12 months to cut interest rates. And what has happened in previous times, on average, we had a negative performance over the next 3 months, which I would believe would make sense for us to have a short pullback over the next few months. It shakes out a lot of the optimism. Then we can go much, much higher. But then over the next year, we had an average of 12 to 14% return. So this is extremely bullish for stocks. But in the near term, some optimism is priced in, and it may not be too bullish. Something else that could back it up is President Trump, and he wants to get Powell's replacement, which I believe in March or April of 2026, Powell would have to, his term would end, and we would have a new Fed chairman. He's likely going to be extremely dovish. And President Trump said that Powell's replacement is from Wall Street. Now, what do you think is going to happen if he's from Wall Street? You know, I'll let you guess this part. Something else that back it up is margin debt. Margin debt is the best indicator of investors' euphoria. And whenever margin debt goes above 50%, like it did in 2022, like in 2021, like it did in 2008, and like it did in 1999, whenever it spikes 50% year on year, this is when you have peak euphoria, peak optimism, peak valuation. We're nowhere close to 50%. Which means that yes, there's a lot of optimism, yes, there's overvaluation, but it could get much, much worse and much, much higher than where it is right now. And this is what Howard Marks is saying. Now, something else, again, that could back this up, and I shared this chart before, 3 months ago, is mainly the golden cross on the S&P 500, which is mainly the 50-day and 200-day moving average. When they cross above each other, 50-day goes above the 200-day, you tend to have a 2 or 3 year bull run in the NASDAQ and the S&P 500, and we get crazy returns. And it has happened from 2020 to 2022, and the NASDAQ went up 98%. It has happened then from 2023 to early 2025, and we went up 88%, and it has just happened again. And I shared it right when it happened, actually, a few months ago, And I told you guys this is the time to buy call options, and I bought call options, did other things. And this is, the nature of the cycle. And this is also backing it up that we could have a 1 or 2 magnificent years before this whole mania is over. Now, the only thing that's not backing it up is the fundamentals. And this chart went down, but I can go back down to the PE ratio. And if you look at the PE ratio of the S&P 500, it's getting extended, guys. Like, we're trading around 22 times forward earnings. 22 times forward earnings is extremely, extremely high, especially if you compare it to where we were in the dot-com bubble. In the dot-com bubble, I believe the S&P 500 has traded around 20 times, 25 or 26 times earnings, and I'm trying to find this chart, but the S&P 500, here we go, it traded around 25, 26 times earnings, now trading at 22 and a half times earnings, and again, we're not too far from where we were in the dot-com bubble. Now, the only thing is, I was surprised that a lot of those companies are growing as fast as they grew. It just surprised me. I was not expecting this year to be a 10% plus year, and I told you guys, I'm very surprised. And if they continue to grow, maybe we can justify it. But again, it's so high that the market is priced to perfection. That's why we sell off on whenever someone says something, whenever Trump says something. If we were trading at 16, 17 times earnings, we would not sell off on when someone says something as much as we do right now. But the market is so fragile, we're so expensive, we're so priced to perfection that anything can shake out this market. And that's what has been happening over the last few months. Now, in terms of the stocks that could do extremely well if stocks, or if you say interest rates, go down, like Jerome Powell is guiding. The first one is the main one. This is housing and refinance. And I talked about this actually in April and May. And I told you guys about the home builders and the housing stocks. They've been doing extremely, extremely well. But I think the main one that will benefit a lot is the refi market or refinance. And the first one that would come to mind is Rocket Mortgage. And it's not bad, but it's not really the best one for Rocket Mortgage. I mean, if you own SoFi or Robinhood, they have a lot of housing loans, refinance. So people want to refinance, they want to buy a new house. You can benefit from that. If you have FICO will do extremely well. So I think a lot of the refinance kind of stocks will do really, really well, and actually much better than the home builders. The second one that could do well is growth in general, which has been doing well, but mainly the unprofitable stocks. So maybe a lot of stocks like the Castlewood Arc Innovation, which I'm not a big fan of, but a lot of those stocks, they are speculative, normally do very well whenever you have lower interest rates, and especially if they start expanding the balance sheet again. Something else that hasn't been doing too well, that could do extremely well, is IWM or small caps. Small caps have been in a bear market for a while. They haven't been doing too well. I own some of them in my portfolio if you're interested, but I think some small caps, so companies maybe 2 billion, under 2 billion, maybe 800 million, billion and a half, they could do extremely, extremely well in such environment, and a lot of them are trading near their lows. Something else that could do really well is the dividend stocks, which have been getting killed over the last 2-3 years. That could be the time for them to do really well. And especially REITs, real estate investment trusts, a lot of them are trading near their 52-week lows, especially the apartment REITs, Avalon Big Community, MAA, Mid-America Apartment Communities. You could look them up, trading near their 52-week lows. Those could look very attractive. Or any company with a high dividend yield should do well, because on a relative basis to the interest rate of the Fed is going to look attractive, and it would do really, really well. Something else that could do well, of course, is gold and cryptocurrencies, because the dollar will most likely be losing value. And if the dollar is losing value, gold and crypto will likely do extremely well against the dollar in a lower interest rate environment. So that's my thesis on the market. I believe we will likely have some kind of a pullback in the next few months, shake out a lot of optimism in the market before we go much, much higher. But that's the most likely setup. And then we go much, much higher before we have some kind of a major crash. I'm not saying like some kind of a 5 or 8% pullback. We're going to have those. Those are normal. We have them once a year, once every 2 years. But I'm talking like a dot-com kind of crash. I mean, based on what Howard Marks is saying, this is a setup that we will most likely have in the market. But before we have such a big crash or such a big pullback, we're likely going much, much higher to peak euphoria before we go much, much lower. So that was my video for today. Hope you learned something. Hope you enjoyed it. Now, financial advice. If you want to learn more about what I do and the stocks that I'm buying and everything I do, this is the link to my group if you're interested. But thank you again, and I'll talk to you in another video.